Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. Well, Uncle Frank, this sucks. Look at that hourly chart. We closed at 739, down 50 cents or 6.34% on no bad news. In fact, we just came off an avalanche of good news. The best third quarter in our history, with nothing but good news on the horizon. And yet we're down 15% over the past week. 22% over the past month, 77% over the past 90 days, and now down 89% year over year. But let's think like a short hedge fund for a minute. This company isn't Blockbuster and it's not Toys R Us. So that leaves me with one question. Why haven't they covered yet? We're under 75 cents on a pre-split basis right now. What are they waiting for? Possibly another pandemic? COVID has been pretty quiet so far. The writer's strike is over. The actor's strike is over. And this company is in pure recovery mode. Why don't they just cover the trade and move on? What could be holding them up? Could it be they can't possibly cover this trade until the market crashes? Well, let's review the evidence. I want to remind you guys that good news for some in the market almost always means bad news for someone else. I'm of the opinion that the Hedgies are very, very short and have been waiting for a big sell-off in the market that hasn't shown up yet. Let's take a look at the world through the Hedgies' eyes for a change. Check out this chart from Zero Hedge. Single stock short selling. Hedge fund U.S. single stock short flows increasing for a record 14 consecutive weeks, according to Goldman Sachs. I don't know about you, but that sounds like they are very, very short. Now, to support my theory, I offer you this headline from MarketWatch only 3 days ago. Hedge funds are betting that stocks will fall and indexes will rise at the same time. While most of my gold bugs like Black Arrow and Dom Pantaleo are rooting for the entire system to collapse, taking the stock market down with it, when it comes to AMC, I have been rooting for surprise upside rallies to burn the predatory short hedge funds. Happy birthday to subscriber and supporter Iron Manny. Why do I always say that? Here's why. From Reuters, systematic hedge funds pummeled in post-US CPI stocks rally, according to Goldman Sachs. Global hedge funds that use algorithms to trade suffered their worst single day this year on Tuesday, as softer than expected U.S. inflation numbers sparked a hefty stocks rally, a Goldman Sachs note showed. Keep this in mind. What else happened on Thursday besides AMC getting clobbered for no apparent reason? Let's review Bloomberg's post-close report. New economic data reinforces speculation the Fed is done hiking rates. A new tranche of economic data today underscored the U.S. economy is slowing down, giving the Fed Reserve room to end its aggressive interest rate hiking campaign to quell inflation. Continuing applications for U.S. unemployment benefits rose to the highest level in almost 2 years. Initial jobless claims rose also. Recurring jobless claims, a proxy for the number of people continuously receiving unemployment benefits, marked its 8th straight week of increases. Guys, check me if I'm wrong, but this all sounds like great news for the markets and bad news for the short hedgies. Do you agree? On your screen, you can see the chart that I mentioned on the slide prior. Continuing U.S. jobless claims rise to 2-year high. But factory production also fell by more than expected, and home builder sentiment hit the lowest level of the year. What this means for the Fed? Now the fight shifts from inflation to preserving economic growth and averting recession, said Jamie Cox at Harris Financial Group. Stocks were little changed and bonds climbed on the data. What this tells me, guys, is the Fed has been successful at strangling the economy with its interest rate hikes, and it finally got around to wrecking the job market. Historically, the last thing it needs to do to stop hiking, and higher bond prices confirm that. But lower interest rates could also mean this market bull could stay around longer than expected. And I need you guys to remember, we apes are not leveraged 40 to 1. We didn't just come off a record 14 weeks of short selling. That's the hedge funds. And they have some other challenges to face that we don't. By now, most of you have heard what happened in South Korea regarding short selling, but let's do a lap around the world to see what hedge funds are currently dealing with to find a clue about the trade against AMC that seems impossible to cover for them. From Reuters, South Korea to bring retail short selling rules in line with institutions. South Korea's financial regulator said on Thursday authorities plan to loosen stock short selling rules for retail investors while tightening rules for institutional and foreign investors to promote a level playing field in the market. The government introduced a controversial ban on short selling in the stock market this month. Moving over to China from Reuters, exclusive. China asks brokerages to curb leveraged stock trades. China's securities watchdog is asking brokerages to restrict leverage available to hedge funds that borrow large sums of money via a complex derivative business to trade stocks, three sources told Reuters. Hedge funds, using the so-called DMA swap strategy, were told by their brokers late on Wednesday to start limiting leverage bets. Two sources who received notices from regulators said. A source at one of China's biggest brokerages confirmed the guidance, citing regulators' concern over market risks. And now let's move to London from Reuters. Global watchdog warns over very high leverage in hedge funds. Leverage is now very high in parts of the $7 trillion hedge fund sector, G20 Risk Watchdog Financial Stability Board warned on Wednesday, while noting that significant data gaps make it hard to get a full picture of vulnerabilities among non-banks or the Hedgies. Let me translate that for you. They can't tell how bad it is. Moving to the U.S. from Bloomberg, the United States weighs leaning on banks to curb hedge fund leverage trading. Top U.S. regulators are zeroing in on dangers posed by highly leveraged hedge fund trades and considering options to rein in risks to the broader financial system. Regulators are especially concerned about the growth of one strategy known as the basis trade, which involves the use of leverage to profit from the price gap between Treasury futures and the underlying cash market. Borrowing in the repurchase market using U.S. Treasuries as collateral has soared in recent years to almost $3 trillion. Although hedge funds are subject to less direct regulatory oversight, tell me about it, they rely on highly regulated large banks to finance many of their trades. That gives several U.S. agencies sway to limit the activity, and in early stage plans, regulators are weighing options ranging from pushing banks to gather more data on exposures to pressing them to ramp up haircuts on some secured borrowing, according to people familiar with the matter. So guys, not only are the regulators in the U.S. government beefing about the hedge funds' leverage levels, but now the Fed Reserve itself is chiming in. The Fed's Michael Barr expressed concerns over the risks of highly leveraged trading by hedge funds in the Treasury market, in particular, the basis trade. Leverage can also increase risks to both market participants and to the Treasury market functioning and must be managed appropriately by both investors and their counterparties, including through collecting margin to manage counterparty risk. Although the Fed collects information on the tri-party repo market, Barr said there's less data on trades that aren't centrally cleared, said the government needed more information about these trades. Sound familiar to you? And all of a sudden, Kenny Griffin is everywhere, fighting everybody, suing everybody, from investment news. Citadel, ASA sue SEC over trading data changes. The firm and trade association petitioned the court regarding the Consolidated Audit Trail, also known as CAT, from Bloomberg. Ken Griffin's Citadel plans to fight SEC over WhatsApp probe. From MarketWatch, Citadel chief Ken Griffin says SEC should focus on banks instead of hedge funds in tackling basis trade risk. From Fortune, a billionaire hedge fund kingpin is feuding with the sheriff of Wall Street over an obscure rule in the multi-trillion-dollar bond market. And my favorite from CNBC, SEC slaps Citadel Securities with $7 million fine to settle short-selling regulations charges. Well, that's when Kenny got charged $7 million for marking millions of short orders as longs. Slap on the wrist. Guys, I am not an investment advisor. This is not investment advice. I will never tell you to buy, sell, or hold any security or cryptocurrency. But the point I'm trying to make is, as depressing as it is to see AMC falling due to the Hedgies and Adam Aron's ape, his investment in a bankrupt gold mine while sexting, getting himself embroiled in a blackmail scandal, the unnecessary reverse split, and then the ridiculously timed dilution announcement killing yet another rally, we have nothing but blue skies ahead until December 1st when Beyonce drops. It's the hedge funds that are effed up right now and not us. So I was nibbling on the stock again today on dips and even picked up the $8 strike calls expiring on Friday, December 1st. Guys, let's review. Total revenue grew by 45.2% compared to quarter three. Net earnings grew by $239 million to a $12.3 million profit compared to a net loss of $226 million. Guys, we finished the quarter with $729 million in liquidity. I mean, we even found out we're going to start selling our popcorn in 2 more food chains. I've got nothing but good news ahead. The hedge funds, in comparison, have nothing but trouble ahead. And all I need is one white swan or one black swan to kick off the party. And how about a little more good news? AMC Movie Theater opens next to North Station. After 3 years of darkness, one downtown Boston movie theater has again turned on its projectors. AMC Causeway 13, a new 13-screen, 66,000 square foot location of the cinema chain, debuted next to TD Garden at the Hub on Causeway on Thursday. The site was formerly occupied by a location of the upscale ArcLight Cinemas, which opened just months before COVID-19 struck. After staying closed through April of 2021, ArcLight shut down for good as the pandemic decimated the movie theater business. AMC purchased the site last December. Guys, I just want you to remember that we've got a lot to look forward to. There's 45 more days for 2023. Okay, and look at this headline from Deadline. AMC Entertainment will lean into concert films after Eras Tour success. Our phone has been ringing off the hook. Then we've got Napoleon and Wish dropping on the same day, November 22nd. And now in the headlines from CNBC, Hunger Games prequel heads for $50 million opening weekend. And from Deadline again, Ballad of Songbirds and Snakes looks to sing $100 million worldwide. Keep your chin up. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.